Welcome back. We are busy with Class 7 investments, and we will now discuss Unit 3.1, which is collective investments. We'll only cover in this section to a limited extent the content of collective investments, as we will spend a whole series on collective investments, as it is quite a large area of investment with various components, and obviously the Collective Investment Schemes Control Act we'll discuss more in detail. We will refer to it as an investment vehicle in this specific chapter. The trust industry in South Africa came about in 1965 when William Schill from Sage Group launched the first unit trust. The original shareholders in the first fund were Liberty, Nedbank, Industrial Underwriting Limited, Liberty Chairman, Donald Gordon, Louis Schill, and some of their friends. The structure of a collective investment scheme. A collective investment scheme pool the money of several investors who want to invest in shares, bonds, and money market instruments. The total fund is then divided into individual units containing the same portion of assets as the fund. The collective investment scheme concept offers full-time management by professionals. It allows investors to benefit from investing in a diversified portfolio, even if investing a small amount. The investor may purchase participatory interest in a collective investment scheme portfolio, and by so doing, participate proportionately in the income or the profit of that specific managed portfolio. A portfolio usually consists of quoted shares but may include fixed interest securities and cash. The price of a participatory interest is directly related to the underlying value of the trust's assets. As these are mainly shares on the stock market, each participatory interest value fluctuates with the price change of its shares. After management fees have been taken, the collective investment scheme distributes all its income and dividends and interest to its investors. Capital growth of the participatory interest is linked to the capital growth of the share held in the collective investment scheme's portfolio. Such investments provide an investor with professional portfolio management at a low cost and with a well-diversified portfolio to limit their risks. Capital profits realized when underlying units are sold unlikely to be taxed as income. This kind of investment is usually made on a long-term basis but will be subject to capital gains tax. The taxation would be according to standard tax principles. For further information, consult our chapters on tax that we also discuss. Different collective investment schemes' objectives vary to include capital and income growth through dividend distributions. Some investors may require growth in income from the collective investment schemes, and collective investment schemes offer a higher degree of security than a direct investment in a share. They also offer the prospect of long-term superior performance. Investors shares in the gains, the losses, the income and expenses of the funds proportionately. The management company decides on the minimum investment amount, which can be as low as 100 Rand per month. The fund value fluctuates according to the value of the underlying securities. South Africa was experiencing an annual average growth rate of 5.6% per annum at the time, and the unit trust offered the man in the street an opportunity to access the growing equity market. Unfortunately, this industry took a knock when the JSE share prices declined in 1969. Due to a lack of knowledge and understanding of equity investments, many investors burnt their fingers and lost a great deal of money. Investors were borrowing to fund additional investments, which leads to increased debt and negative returns. A collective investment scheme is a fund operated by a trust company or a bank and handles a pooled group of trust accounts. Collective investment funds combine the assets of various individuals and organizations to create a more substantial well-diversified portfolio. The following are two types of collective investment funds. You get A1 fund, a fund of grouped assets contributed by either the holding bank or the affiliated banks for the exclusive purpose of investment and reinvestment, or A2 fund, which is a fund of grouped assets contributed by pension, profit sharing, retirement, or other assets that are exempt from income tax. The idea of a collective investment fund is to lower costs through economies of scale by combining pensions and profit sharing funds. These pooled funds are grouped into what is known as a master trust account under the control of the bank, which act as trustee, guardian, executor, or the administrator. Diversification. Unit trust represents a basket of shares, commodities, or properties and provide broad exposure rather than focused exposure of underlying share trading. Liquidity. Unit trust can be bought and sold daily, which means your investment is always available should you need it. Accessibility. Unit trust can be traded using your provider unit trust account as a once-off transaction or via a monthly debit order payment. The flexibility. Your provider offers you access to a wide range of unit trusts from several different providers, including the PSG Fund Management, Allan Gray, Coronation, and Investec. Unit trusts do not restrict you to fund from one management company. It's tax efficient. Unit trust managers may trade within the unit trust portfolio without becoming liable for any income tax on profits. Long-term investors can therefore benefit from active and frequent trades on the part of the fund manager, while only becoming liable for capital gains tax or CGT. Transparency. Unit trust owners know exactly what stocks or underlying assets they hold and what their value is. Long-term savings. Unit trusts work very well within a retirement portfolio, such as a retirement annuity, a pension, or a provident fund, that allows you all the tax benefits of a retirement fund with the added advantage of choosing your underlying fund managers. Income. Because the underlying assets earn dividends or interest, you can receive an income from unit trust portfolio without reducing your total investment. Cost. You can make a once-off purchase into a unit trust or a monthly debit order. If you wish to make a once-off purchase, you must deposit funds into your collective investment schemes account before making the purchase. Debit orders are collected monthly from your bank account. The structure of a collective investment scheme. Unit trust investing costs vary depending on your choice of collective investment scheme. Collective investment schemes also charge performance fees when outperforming an established benchmark. The legal entities. Each collective investment scheme has three legal entities. The fund is one, the trustee, and then thirdly, the management company. The fund itself. The fund consists of the cash contributions of the investors. The cash pool is invested in shares, cash, bonds, and property. The fund cannot be declared insolvent. It can only be liquidated to pay out the unit holders. The trustee. A trust deed governs collective investment schemes under the authority of the Financial Sector Conduct Authority, or FSCA. Collective investment schemes are obliged to appoint a trustee to exercise fiduciary control. A bank usually takes up this position. The trustee is the custodian of all the cash and securities within the fund. The fund's assets are held in the trustee's name. The appointed trustee ensures that the fund is managed within the specific terms of the trust deed. The trustee's job is to protect the investor from the misappropriation of funds. The deed specifies the goals of the fund. The deed shows the charges and fees paid to the management company, and the pricing and details of the formula for unit trusts are also set out. If we look at the management company, the body acts as administrator of the fund. A team of investment managers, either working with the company or outsourced, make the investment decisions and control the buying and the selling of securities. The collective investment scheme manager charges a once-off fee at entry and an annual administration fee. The annual charges of a specific collective investment scheme vary with the performance of the underlying portfolios. Then we look at the asset manager. Asset manager of a collective investment scheme may be part of collective investment scheme manager, or it could be a separate company. The CIS company often outsources the portfolio management to an outside manager. A team of analysts or researchers would typically back up the asset manager. In the past year, there has been a good deal of debate around the advantages of investment houses with in-depth support vis-a-vis smaller boutique manager houses. About fees on collective investments. Collective investment scheme management companies normally levy a management fee at a rate of 1% per annum plus VAT of the average monthly market value of the portfolio. Fee prices are now more flexible than they have been in the past. Some funds now link the fee charges to the performance of the fund. The management company can also deduct management fees from the accrued income of the fund and not the capital invested. Broker fees are part of the initial fees charged by the management company. These comprise about 3% of the initial investment. This amount usually decreases as the size of the investment increases. There has been an international move towards the direct buying and selling of collective investment schemes. It can be done through the internet, toll-free numbers, or direct desks at the collective investment scheme management company. There appears to be a growing resistance to paying broker fees, and some companies have chosen the route of direct selling. The Insurance Broker Council have reacted strongly in the light of the members' livelihoods being threatened. They also point out that consumers will not get a better deal as they will not get the advice brokers can offer them. Some collective investment scheme companies rely on brokers to bring them business and are thus reluctant to alienate them by introducing direct desks. Broker commissions are negotiable. Investors can ask for a discount. Some collective investment scheme companies have toll-free numbers with consultants who answer questions on collective investment schemes and also sell collective investment schemes. They can discount the initial fee by up to 1.5% if asked to do so. Collective investment scheme management charges were deregulated in June of 1998. New funds created after that date were permitted to set their fees, and they notified unit holders of those fees. Existing funds were only allowed to alter their fees with unit holders' approval. Unit holders were not in favor of the increased fees. Consequently, in April of 2000, further deregulation occurred. Existing funds had to maintain their old fee structure for existing units, Class R fees, but could introduce a different scale of fees for new investors, which is a Class A fees. A different fee structure applied to institutional or wholesale clients, for example, Class B or Class C fees. A management company may therefore have 4 or 5 sets of charges for its collective investment scheme funds. They could vary anything from 0.25 per annum to 1.5% per annum. In some cases, performance fees may also be charged if an agreed benchmark is exceeded. This variant in fees applies not only to management fees but also to the initial charges. Thank you. That concludes this introductory session on collective investments. We will discuss this in greater detail in one of our other sessions. The next session that we'll look at, which will be Unit 3.2, will be linked and market-related investments. Thank you for attending this one. See you in the next session, Unit 3.2, linked and market-related investment.